Bracing for impact. The market might be preparing for a soft landing, but continued signs of Fed hawkishness could mean we're more likely to see negative rather than positive results. Are the markets misreading optimism? Joining us now with more, Calvin C. is BNP Paribas, head of America's macro strategy. Calvin, thanks for being here. We all well remember transitory and how persistent transitory was, ironically, in the Fed's thinking. Are we going to see this optimism over a soft landing as misguided in the same way?
That's what we think. Transitory inflation, as you correctly say, was the catchphrase of 2022. And we think that soft landing, which is the catchphrase of a still young 2023, is similarly going to be going out the window. The signs that we see clearly show a deceleration of the U.S. economy going into the end of last year. And we think the data will continue to roll over at the beginning of this year, solidifying our call for a recession.
What data is going to be the first to really roll over, perhaps, and then trigger the rest of what the Fed is watching and their core indicators that they're keeping tabs on?
Sure. The U.S. economy, as we know, is a consumer-based economy. So the key really is going to be what the consumer is doing, how much they're spending, and as a result of that, how strong the labor market is. The Fed has been consistently telling us to not only focus on realized inflation, we know it's coming down this year, but to also focus on the employment side of their mandate. Employment is still incredibly strong, and the Fed wants to see signs that it falls apart more rapidly before feeling more comfortable taking its foot off the brakes. So for us, we think the risks are towards a more hawkish Fed next week.
Calvin, I talked to Amex's CEO this morning, and he told me he's not seeing any recessionary signals. Are execs just missing something? It's just amazing to hear a lot of execs just downplay the threat of a recession.
So far, the signs haven't necessarily been there yet. The end of last year was stronger than most people expected. Again, fourth quarter GDP was strong. But when we look forward, remember, monetary policy, as we know, acts with long and variable lags. And these long and variable lags, we think, are finally hitting the economy. And given what we've seen intra-quarter in the fourth quarter, that to us is showing signs of deceleration, a weakening consumer, weakening imports, inventory builds. These are all signs that we see that confirm our belief that a recession is going to happen, and the markets don't have this priced in.
So talk to us about how this is going to manifest with the Fed. You mentioned next week we might get a more hawkish Fed. Does that mean that the consensus around 25 basis points is incorrect, or do you think it's more going to be a tonal shift, if you will, from the Fed?
We think that a 25 basis point rate hike is pretty much locked in, so the markets have that right. It's about what the markets have priced going forward. The markets have a very dovish path priced in for the Fed. The markets don't even have the Fed's median SEP outcome for terminal priced in. And the markets are pricing in a very rapid pace of rate cuts in the back half of this year, which we don't agree with. So we think the Fed is going to continuously push back against those rate cuts. And as those cuts are taken out of the curve, we think that's one of the key catalysts that's going to get risk markets down.
So just to put a fine point on this, there's been this whole debate over that the markets and the Fed are not in the same place. Who is going to be right and who is going to be wrong? You say the Fed is going to have it here.
Based on what we see now, we think it's going to be the Fed. And that's really based on our read of inflation. We think that inflation is going to remain very sticky. It's going to come down, but it's going to remain above target and at elevated levels. And so long as that's the case, and so long as the labor market still remains relatively strong, we think that the Fed will want to keep policy in restrictive territory for a longer period of time.
So for all the investors that have been hearing a recession is coming, what is the strategy then for their portfolio?
So for us, we have trades that we like across asset classes. In equities, we think that given the markets are not pricing in a recession, the markets are very complacent at the moment. What we see is that risk premium is very low. So we like to own equity volatility. We like to buy the VIX. Concurrently, we would like to finance those positions by putting on payers in the United States in the front end of the curve, i.e. betting on the Fed not cutting rates this year.
And also more broadly, I mean, the sort of consensus among strategists on Wall Street is that stocks will go up this year a little bit, won't be a lot, going to be kind of a meh year. Do you think that scenario is also too optimistic? Are we going to see more of a harsh come down for U.S. equities?
We think it is too optimistic. We think that the markets are just priced in now already for a soft landing. The markets are pricing in roughly 10% earnings growth next year. The markets are trading at about a 17 and a half times multiple. That's already pricing a soft landing. As the economic data deteriorate, as the markets move towards our recession view, we think that there's at least another 10% downside in stocks this year.